let's dive in today. We're going to be tackling U.S. fiscal policy
Ooh.
and how it impacts exchange rates and trade balances. It's one of those things, that everyone's always talking about. But no one really seems to fully understand.
Yeah, it's complicated.
Yeah. So we're going to try and break it down using this academic paper. It had some interesting points in it.
Yeah, it's really thought-provoking. I mean, it kind of challenges some conventional wisdom about how government spending actually plays out on the world stage.
Yeah. So imagine you're going into a meeting and everyone's throwing around terms like fiscal policy and trade deficits.
Yeah.
And we're going to make sure you're not just nodding along. We're going to make sure you're actually
you can contribute.
Contributing to the conversation with some real insights.
You'll be able to impress even the most seasoned economics buff.
Yeah. So the paper starts by presenting this puzzle. You'd think that if the U.S. government spends more money, especially if they're borrowing to do it, the dollar would weaken.
Right. Yeah.
Right? Like if you print more of something,
more supply,
it becomes less valuable.
Yeah, you would think that. And a lot of the standard economic models, really that's what they predict.
Right.
The idea is that when the government spends more, it increases demand for goods and services, which can drive up prices.
Right.
And then if things cost more in the U.S., people are going to start looking for cheaper alternatives, meaning they'll buy more imports and fewer U.S. exports.
So more imports, fewer exports equals a worse trade balance for the U.S.
Got it.
But here's where things get weird. It doesn't actually work out that way.
That's the fascinating thing.
In reality.
What's really interesting is that the data shows that when U.S. government debt increases, the dollar tends to get weaker. And the U.S. trade balance actually improves.
So are the models just totally off base then? What are they missing?
Well, the paper suggests that they're oversimplifying things.
Okay.
They don't take into account these things called financial market frictions.
Frictions. Okay, so that sounds a bit technical. Can you break that down for us?
Yeah, think about it like trading baseball cards.
Okay.
You can't just magically swap cards with someone across the country instantly.
Yeah.
There's time involved.
Yeah.
Maybe you need a meetup or you're using an online platform with fees. Those are like frictions in financial markets.
So like there are hidden costs involved in moving money around.
Exactly.
Buying and selling different assets. It's not
as seamless
as the models assume.
Exactly. And those costs matter.
Yeah.
Especially when we're talking about investors deciding where to put their money.
Right. And I bet it does. But I'm still not quite sure how those frictions actually change things. Like, help me connect the dots.
So let's think about it in the context of U.S. government bonds.
Okay.
So when the government needs to borrow money, they issue these bonds.
Right.
Now, investors all over the world are looking for good places to put their money, right? So they're comparing different bonds. They're looking at U.S. government bonds, bonds from other countries.
Right, like shopping around for the best deal?
Exactly. Now, without those frictions, the models say that investors will quickly shift their money to wherever they can get the best return.
Right.
So if the U.S. government issues a bunch of new bonds, the increased supply would push down their price, which is the same as pushing up the interest rate. And that higher interest rate would attract more investors, which would strengthen the dollar.
Okay, so that's the model we talked about earlier.
Right.
But in the real world, with all those frictions you mentioned, things get a bit more complicated.
Precisely. Investors have to consider those extra costs when deciding whether to buy U.S. bonds.
Right.
It's not just about the interest rate anymore.
So what does make them decide to buy those U.S. bonds?
Yeah.
When there are all these frictions to deal with?
Well, that's where things get really interesting.
Okay.
And that's where we'll pick things up in part 2.
So we left off talking about those frictions and how investors really have to weigh those, those extra costs when deciding whether to buy those U.S. bonds.
Yeah.
And it's not just as simple as chasing the highest interest rate.
Exactly.
So what's the tipping point? What makes it worthwhile for them to deal with that hassle?
One key factor is the expected future value of the dollar.
Okay.
So imagine you're an investor, you're holding a bunch of euros.
Okay.
And you see the U.S. government issuing a ton of new bonds.
Right.
Which we discussed should push up interest rates. But you also know there are these frictions to consider.
Right, like having to pay a fee every time you exchange those euros for dollars to buy those bonds.
So to make it worth your while, you need an extra incentive. And that incentive often comes in the form of a weaker dollar today.
Oh, gain.
Because if you buy those U.S. bonds when the dollar is relatively weak, you stand to gain if the dollar strengthens later on.
So it's like buying something on sale.
Exactly.
Hoping that the value will go up.
A great way to put it.
In the future.
And that potential for future profit can be enough to offset those friction costs, making U.S. bonds attractive, even if that interest rate isn't dramatically higher than other options.
So instead of the dollar immediately strengthening when the U.S. borrows more money, we actually see the opposite.
Yeah.
It weakens.
At first.
Because of those frictions, almost like a delayed reaction.
Precisely.
Yeah.
It's one of those nuances that those simple models just don't capture.
Right.
And remember how we talked about a stronger dollar leading to a worse trade balance?
Right.
Well, when the dollar weakens, it has the opposite effect.
Because U.S. products become cheaper.
Exactly.
For people buying in other currencies.
A weaker dollar makes U.S. exports more competitive.
Right.
Imports become more expensive for U.S. buyers.
Right.
So the result is a stronger trade balance.
Okay.
More exports, fewer imports.
So these frictions totally change the game then.
Yeah.
Instead of the expected outcome of a stronger dollar and a weaker trade balance.
Right.
We see the reverse.
That's the key takeaway here.
Yeah.
The paper is highlighting how crucial it is to consider these real-world complexities when we're thinking about the impact of government policies.
This is kind of blowing my mind.
Yeah.
So basically, the U.S. issuing more debt can actually lead to a stronger trade balance.
At least in the short term.
In the short term.
Because of these financial market frictions.
Yeah. It's all interconnected.
It is, and it underscores this point that government actions, especially when it comes to finances, have ripple effects that go way beyond national borders.
Okay, I'm starting to see the bigger picture here. But where does this all lead? Like, what happens in the long run if the U.S. just keeps racking up more and more debt?
That's the million-dollar question, and that's what we'll dig into in the final part of our deep dive.
All right, we're back and ready to wrap up our deep dive. We've been talking about all these financial market frictions and how they really impact things. But what happens long term? I mean, is there like a limit to how much debt a country can take on, even when it's big and powerful as the U.S.?
That's the big question, right? And this paper actually suggests the U.S. might be in a kind of unique position when it comes to managing its debt.
Unique out. Does this have something to do with the dollar being like the world's reserve currency?
You got it.
I know that's a big deal, but I never really understood what that actually means, like for the U.S. economy.
Well, think about it. The U.S. dollar, it's used for so many international transactions, right?
Yeah.
And central banks all over the world hold dollars as reserves. And then, you know, during times of global uncertainty, investors, they flock to the dollar because it's seen as like a safe haven.
So there's always huge demand for dollars no matter what.
Pretty much. And that demand extends to U.S. dollar-denominated assets, like, you know, U.S. Treasury bonds.
Oh, okay.
So even if the U.S. government issues a ton of new debt, there's always buyers out there.
So it's like the U.S. has a bit more wiggle room because of the dollar's special status. They can borrow more without, like, freaking out investors.
To some extent, yeah. But this paper, it makes a point of saying this isn't a free pass. Remember those rebalancing costs we talked about?
Right. The friction costs.
They act like a sort of pressure gauge.
A pressure gauge. How so? I like that.
Well, think of it this way. As the U.S. keeps issuing more and more debt, those friction costs, they kind of gradually increase for investors, right? Becomes a bit more expensive, a bit more of a hassle to buy and hold those U.S. Treasury bonds. And that puts downward pressure on the dollar.
Which then makes U.S. exports more competitive, and that boosts the trade balance, right?
You got it, like that self-correcting mechanism we were talking about before.
Yeah.
But here's the catch. The paper suggests there's like a tipping point. If the U.S. just keeps pushing the limits, if that debt keeps piling up, those rebalancing costs could get so high that they start to disrupt global financial markets.
Whoa, okay. That sounds like a big problem.
Yeah.
What would that kind of disruption even look like?
It's hard to say for sure, but it could involve a sudden loss of confidence in the U.S. dollar. Investors might get spooked and just start rapidly selling off U.S. assets, including those Treasury bonds.
But wouldn't that cause interest rate to, like, skyrocket?
It very well could. And then that would make it way more expensive for everybody, governments, businesses, you know, normal people to borrow money. And that could trigger, you know, a cascade of economic problems.
It's just like a chain reaction. One thing leads to another, and suddenly the whole system's a mess.
Exactly. And it just highlights that tightrope walk policymakers have to manage. They need to, fund the government and all its operations, but they also need to be mindful of those consequences that could come from borrowing too much.
It's a really delicate balancing act with, like, really high stakes. This deep dive has really been eye-opening.
It really is. The decisions made in Washington, D.C. about U.S. fiscal policy, they have these ripple effects that go way beyond national borders.
Absolutely. Well, deep divers, I don't know about you, but I feel a lot smarter about fiscal policy, exchange rates, and all those hidden costs, the frictions that we don't always think about.
It's all about peeling back those layers, right? Looking at the complexity behind those headlines we see about the economy.
Couldn't have said it better myself. We're going to leave you with one final thought today. We talked about those rebalancing costs acting like a pressure gauge, a warning system. But what happens if those warnings are ignored? What happens if that pressure just keeps building and building? It's something to think about. Until next time, keep diving deep.